Something happened yesterday that changes absolutely everything about your money, and the reason it changes everything? The data dropped on the one day of the year when you couldn't do a single thing about it. Friday, April 3rd, the Bureau of Labor Statistics released the March Jobs Report. 178,000 jobs added. Unemployment ticks down to 4.3%. On any normal Friday, Wall Street would have 6.5 hours to trade on those numbers. But Friday was Good Friday. Every cash equity market in the United States was totally dark. No buying, no selling, just silence. But behind that silence, the largest financial institutions on earth spent this entire weekend running their risk models, preparing for what happens when the opening bell rings on Monday, April 6th. I need you to understand, Monday isn't just about the jobs number. The jobs number is the detonator. The explosive has been building for weeks. Let's start with that headline jobs number, because it is a trap. 178,000 jobs sounds like a recovery, but look under the hood. First, they quietly revised February down from a loss of 92,000 jobs to a loss of 133,000. That is a massive 44% downward revision. The media ignored it because the March headline was shiny enough to distract you. Second, look at where the March jobs came from. Healthcare supposedly added 76,000 positions, but 35,000 of those were just physicians returning from a Kaiser Permanente strike. Those aren't new jobs. That's a statistical mirage. Wage growth dropped to 3.5% annually. Hours worked are shrinking to 34.2 hours. Employers cut hours before they cut heads. Discouraged workers jumped by 144,000 in a single month. The real unemployment rate, the U6, is ticking up to a dangerous 8%. This is a labor market fracturing in slow motion, and the market hasn't had a single second to price this in. This brings us to the most dangerous part of Monday's open. The data is ambiguous. It's strong enough on the surface that the Federal Reserve cannot justify emergency rate cuts, but weak enough underneath to signal a recession. Jerome Powell is completely paralyzed, and he's paralyzed while a geopolitical powder keg is exploding. The conflict with Iran has fundamentally altered the global energy landscape. The Strait of Hormuz is disrupted. Kuwait is declaring force majeure. Iraq slashed production. Brent crude spiked to nearly $120 a barrel and is sitting above $111 right now. Every recession since World War II except for the pandemic was preceded by a major spike in oil prices. When energy costs surge, it's a tax on every business and every household in America. You are paying for it at the grocery store, at the pump, and in your heating bill. If you want to know what's going to happen, don't listen to the pundits. Look at what the billionaires are doing with their own money. The March Bank of America Global Fund Manager Survey just dropped 210 institutional managers controlling $589 billion. In just 60 days, these managers went from holding the lowest cash levels on record to executing the largest cash build-up since the March 2020 pandemic crash. They didn't just sell, they panicked. They rotated out of consumer stocks and hid in healthcare, staples, and cash. They cited inflation and geopolitics as massive tail risks. They are pricing in stagflation, stalling growth combined with surging prices, and they are terrified of one specific thing: private credit. It's a $2 trillion shadow lending market. BlackRock just blocked nearly half of the withdrawal requests from its $26 billion private credit fund. Blackstone is facing nearly $4 billion in redemption demands. When the biggest asset managers in the world drop the gates and say you can't have your money, institutions are forced to sell whatever else they can get their hands on to raise cash, and what they sell are public equities, your stocks, your index funds, your 401,000. This brings us to right now. The S&P 500 is already down 8% from its January highs. It broke its 200-day moving average. The CAPE ratio is sitting at its second highest level in 150 years, only surpassed by the peak of the dot-com bubble. Monday's opening minutes will be the most violent, volatile trading session we have seen all year. 48 hours of institutional algorithms, pent-up analysis, and repositioned futures contracts are all trying to cram through the same door at 9:30 a.m. Eastern. The pattern in every major market collapse is identical. The data arrives, the professionals quietly reposition, the public is told everything is fine, and then reality hits. The smart money moved in January, they accelerated in February, they dumped in March, the bell rings on Monday, the mechanism is fully loaded. The only people who will be surprised by what happens next are the ones who refuse to look at the data. I laid out the data, I showed you the institutional trap, I warned you about the Good Friday data gap, and now the window for preparation is closing. The opening bell is about to ring, and the algorithmic slaughter is loading up into the queue. If you are watching this, you already know why this is happening. The Iran oil shock, the paralyzed Federal Reserve, the 133,000 revised job losses, and a massive rotation to cash by the smartest money on Wall Street. Now let's talk about exactly what you do about it, because knowing the storm is hitting means nothing if you don't know how to board up your house. Here is your step-by-step execution playbook for navigating the most volatile trading session of 2026. Step 1. Do not touch a single button for the first 45 minutes of trading. Listen to me carefully. At 9:30 a.m. Eastern, you are not trading against human beings. You are trading against multi-billion-dollar quantitative models that have been digesting 48 hours of delayed economic data. You will see massive phantom spikes. You will see violent flash crashes in individual tickers. This is not price discovery. This is algorithmic order book clearing. The machines are hunting for liquidity, and if you place a market order in the first hour, you are volunteering to be their exit liquidity. Sit on your hands until 10:15 a.m. Eastern when the human institutional managers step in to stabilize the board. Once the dust settles from the open, you need to assess your exposure. The professionals aren't trying to make 20% in this environment. They are trying to prevent losing 40%. Here is the three-pillar defense the smart money is currently hiding in. Pillar 1 is short-duration cash. The 4.3% institutional cash rotation I showed you in the Bank of America survey isn't sitting under a mattress. It's sitting in 1-month and 3-month Treasury bills. With the Fed paralyzed, short-term yields are your shock absorbers. You get paid to wait out the volatility risk-free. Pillar 2 is the energy and gold fortress. With crude oil pinned above $111 a barrel and the Strait of Hormuz effectively shut down, energy is no longer a trade. It is a structural necessity, but look at gold. Central banks are hoarding it at record speeds, pushing it toward $4,800. They aren't buying gold to get rich. They are buying it because they know the Fed cannot print its way out of a stagflationary oil shock. Gold is the ultimate insurance policy against central bank paralysis. Pillar 3 is defensive equities, but with a major catch. If you must hold equities, the rotation is strictly into healthcare and consumer staples, the things people are forced to buy regardless of the economy. But check the balance sheets. In a private credit crunch, any company relying on rolling over cheap debt is toxic. If they have high floating rate debt, drop them, period. Just as important as what you buy is what you absolutely must sell or avoid. The private credit contagion is the wild card today. When BlackRock and Blackstone are getting redemptions, the stress doesn't stay in the shadows. It bleeds into the public markets. Avoid regional banks. They are heavily exposed to the commercial real estate loans that private credit was supposed to rescue. Avoid unprofitable tech. The era of funding cash-burning software companies with cheap money is dead. When liquidity dries up, these stocks don't just correct. They get zeroed out. And avoid high-yield junk bonds. The default cycle is starting. Do not reach for yield in a market where corporate bankruptcies are accelerating. Wall Street makes its money by complicating the truth. They want you confused, emotional, and reactionary. But wealth isn't preserved by panic. It is preserved by cold, calculated, mechanical discipline. You now have the data. You have the institutional roadmap. You know exactly what the machines are going to do when that bell rings. Do not let a relief rally fake you out. Do not buy the dip on leveraged garbage. Protect your capital, secure your cash flow, and let the over-leveraged players wipe themselves out. I'll be monitoring the credit spreads and the bond market liquidity all day inside our subscriber terminal. The bell is about to ring. Stick to the plan. Protect your downside. I'll see you in the trenches.